Palisade Radio is brought to you by First Majestic Silver Corp., one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the line with us today is a new guest to the program, Jonathan Wellum. He has got a company named RockLinc Investment Partners. That's RockLinc, LINC.com. Jonathan has about $100 million under management. Jonathan, welcome to the program.
Great to be with you, Colin. Look forward to speaking with you and your listeners.
You're in the business of wealth preservation and managing folks' money up in Canada, which is certainly a difficult task right now with all of the different issues going on in the world, rising debt levels, higher obligations for governments in the coming years that are unfunded liabilities, a world that we're entering of negative interest rates. And I want to ask you, starting off, you've done a piece for us on Palisade Research that you contributed, which I'll put a link to in the summary of the video here. I want to ask you about the environment that we're living in today and the different issues that you're seeing arising.
Yes. A bit of history. I mean, I started back in 1990. If we go back to 1990, that was the boom years that began with the 90s and coming out of the 80s, where you had interest rates coming off of very, very high levels. As people know, you go back to the Paul Volcker days in terms of the Federal Reserve and so on. And people were converting from fixed income to equities, and they were leveraging and they were borrowing, and you had this sort of debt binge that really got quite large. And so in the 90s, we made lots of money buying financials and buying a lot of the fund companies, mutual fund companies, banks, all the organizations that were taking advantage of the leverage. Fast forward to 2007, 2008, and you saw that a lot of this creation of debt and credit instruments just reached an amazing proportion that was just simply not sustainable. And then you had, as everybody knows, the financial debacle, financial crisis. Well, I looked at that, and we managed money through that whole process and did fairly well at it. But as I set up RockLinc, in the midst of all of that, as you go back and you look at the bigger picture, I couldn't help but be overwhelmed by just the significant level of debt and the fact that it was not slowing down. So you'd expect to go through a financial crisis, you'd expect to go through the challenges that we saw back in 2008, 2009, and then you'd see some corrective action. Well, we didn't see any corrective action. We saw money printing, a lot of quantitative easing. I mean, everybody I think knows the numbers. If you go back to that period up until today, about 12.5 trillion US dollars added to the financial system. 100 billion a month still being added. 100 billion a month of new money, whether it's a European bank or whether it's the Bank of Japan. You've got interest rates that have been manipulated down further and further and further. Rates that when I got in the industry were 7-8% are now virtually zero, and in many countries negative. As people know, there's $7-8 trillion worth of debt that's gone negative. And so you look at all of that, and you look at the unfunded liabilities, and you look at just the promises the governments continue to make. And if you're an investor in the capital markets, you should be worried. You should be very concerned. You should be definitely focused on wealth preservation. So looking after clients' money and talking to clients, I'm constantly, again, reminding them that these are not normal days, that when you see interest rates at zero and even going negative, this is a sign of dysfunction. It's a sign of an unhealthy economic system. And this means that we need to be prepared for tremendous volatility, in my view, and in market turbulence, market trouble. So that's really driven me. I go over the last 6-7 years in particular as I set up now RockLinc Investment Corp, and dealing with people that cannot afford to lose money, or looking at preservation, or looking at solid, strong returns, to really evaluate every single business we go into, every asset that we invest in, to make sure that they're generating strong, long-term cash flows from essential businesses, from businesses that are scarce, and businesses that have a consistency to them in terms of the cash flow without a lot of leverage. So that's driven us really over to a good weighting in precious metals. and your audience and listeners are very familiar with that area. I've invested in precious metals over the years, but nowhere near to the extent that I do now, because I do believe it's probably one of the best areas to protect people's capital. And we in particular have focused on a lot of the royalty companies, the finance companies, the Franco, Royal Gold, Sandstorm, Silver Wheaton, and along with some of the smaller miners, in order to really protect clients, be more proactive in terms of hedging them against what we see as real financial risk ahead of us as interest rates have been brought so low. And we're really dependent now, as you know, on money printing and the goosing of the system by the central banks, which is simply not sustainable. And I think from going forward, it's actually causing more harm than good. And this is a big problem if you're an investment manager like ourselves.
Precious metals investors over the past few weeks have done exceedingly well, and sometimes it's important to take that in context of how much money is actually going into the precious metals sector. For example, somebody with a junior portfolio might be up 10% today and yesterday, which is staggering. But that can lead people to think, how long can this last, and forget just how depressed the prices have gotten in this sector. Jonathan, you're talking to people on a daily basis, call it normal people that do have a nest egg, but just kind of a representation of people across Canada. What kind of weighting do they have to gold right now? Is there any interest from those people before they run into a person like yourself?
Yeah, it's a great question. We've taken in quite a large number of new clients just this year, and every single new client that we took in this year, and most of them coming from brokerage offices, the large brokerage offices here in Canada, they have literally zero exposure to precious metals. I mean, it blows my mind. I mean, not even 2 or 3% or 5%, zero. And what they do have a lot of, and this is in the Canadian context, is all sorts of oil and gas, and in many cases speculative oil and gas companies, not even the best quality ones. And so the first thing that you sit them down and you say, look, we've got a record debt problem in the world, but also even in Canada. I mean, in Canada, we've got a huge debt issue provincially in our own province of Ontario, where I operate. Canadian government now is embarking on a binge in debt in terms of their expenditures, and the personal problem in Canada is one of the worst situations in terms of debt, with a debt of about 170 percentage debt to income level, which is right off the chart. So you sit them down and say, look, we've got a debt problem. We have a government that is out of control in terms of spending now and sucking up more and more of the private sector and pulling it into the public sector. We've got central banks around the world which are punishing savers and forcing really bad behavior in terms of the capital markets. And so you have to protect yourself. So you've got to protect your purchasing power, which is a key thing when you're investing, is how can I transfer my labor into a savings program that's going to protect my capital purchasing power. So first thing that we do is we put them, depending on the client and where they are in terms of stage in life, we're going to put them into at least up to 10% or more of their equities into precious metals immediately. And we do that through from our perspective, some of the highest quality companies. Now, that's not saying anything bad about the smaller ones. We're sympathetic to that, but with our client base, they're looking again for consistency, a certain sense of predictability. But we definitely are going to move them into that space absolutely right away and build good positions, because I think it is absolutely essential going forward, given, again, the bigger picture problems that are facing us. And the majority of people, on the street, the average person, does not have any sense of the gravity of the overall challenges to the monetary system that we're experiencing. They just do not understand it. So we take a fair bit of time and walk them through that to prepare them and to, again, acclimatize them to the challenges that are inevitably ahead of us.
In the 1990s, Jonathan, your funds were the largest shareholders of Franco-Nevada. I don't know what dollar amount that equates to, but it's very significant. And that goes to show that you've been around in the sector for some time. You've kept a good eye on the precious metals sector, and that must give you some indication of where we are now. As we just discussed, we have been moving off the bottom. Things are looking up for the precious metals sector. What do you expect over the next few years based on your past experiences on the type of gains? Even a strong company like Franco-Nevada that hasn't seen the carnage of the juniors, what is it going to return possibly for investors?
Yeah, and you see, back in the 90s, we ran very large portfolios. At one point, we were the largest private mutual fund company in Canada. We were up to about 15 billion that we managed Canadian, and our biggest positions were in these fee-based companies. These companies with reoccurring revenue, sort of perpetual long-term revenue streams, and we really liked the Franco-Nevada because of course, Seymour Schulich, Pierre Lassonde, the two key principals of Franco and Euro Nevada at the time. And but what they did is they were able to cut beautiful deals off of gold, particularly gold mines, and then generate long-term cash flows that would be protected from inflation because they're rooted in gold. And the net smeltering returns on volume, the net profit interest that they generated, because they were royalty companies, not streaming companies at the time. And it really taught us that, number one, when you're investing, you're buying cash flow streams. Number two, you want cash flow streams that can grow and that give you upside leverage, which clearly you would in a royalty company or environment where you've got an increasing price of the underlying commodity. And three, they're going to hedge your purchasing power in a world where there's tremendous excess debt. And there is the concerted effort on the part of central banks, and we know this, to debase our money. So they want to debase our money. This is their whole goal. And so if they're doing that, you want to buy things that will hedge against that and protect you. So back in the 90s, we built this position not because we were gold bugs or anything. We saw a tremendous cash flow vehicle. Now, fast forward to today, and you look at the streaming companies or really well-run mining companies. It's exciting now because the mining companies have all, especially the smaller, mid-tier, well-run mining companies, they've all restructured, and so the profit margins that can accrue to them will be tremendous, and the operating leverage will be huge. So when we look at whether it's the bigger streaming companies, royalty companies, or some of the really well-run mining companies, you've got tremendous cash flow that can come out of these companies. They are honed, they're in much better shape, and the cash flow is coming off of gold and silver. And if you are in a world where they're trying to trash paper money, they're trying to undermine the fiat currency, they're actually going to charge you a tax or a fee to sit in cash in the bank, then you have to look at gold, you have to look at silver, but you want to find, in our view, what we're looking for our clients are the best, the predictable, the ones that are in safe geographic regions that can give us tremendous upside, because it's the only way you're going to ultimately protect your cash flow. Now, we look at a few other sectors, water industry, some agriculture areas, infrastructure, but in every case, we're looking for businesses that are structured to protect against purchasing power loss, and they're operating investments or assets that are essential, they're scarce, and there's a predictability to the business model. And that's what people really have to zero in, especially today. I mean, this negative interest rate situation, if people don't see that as just blatant theft and blatant undermining of the capitalist system in order to prop up debtors, the largest of which are governments, and allow governments to continue to get more bloated and more bureaucratic and lay down more regulations and more control of the economy, which is just bringing all of the economic growth to a real halt around the world. If you don't see that, then I think you're not operating in the same universe that certainly we are, and are not seeing what the kind of risks that lie before us, which we think are very significant.
Gold traditionally has worked as a leading indicator to inflation that's coming or has already started, but I've heard, I should say, several times in the past that gold moves before people see the inflation, and so if you're not positioned ahead of time and aware of what's going to happen, you're going to be the general public jumping into gold at $2,000, $3,000, $4,000 an ounce, whatever it ends up going to, and you miss so much of the gains. Is the movement that's starting to happen in the mining sector and in gold and silver prices, is that indicative of inflation is now right around the corner, or does it tell you something different?
Well, the way I look at it, Colin, is that when I look at the financial system as it is now constructed, and as they are now pushing it forward, and when I say they, I mean governments and the central banks, it is completely unsustainable on the current course. Okay, so when I mean that, you can't grow $3, $3.50, $4 debt for every GDP growth. You can't run interest rates negative and expect people to save. You can't have interest rates where they're at and have any kind of pension programs in the future, because you've got 30-40% of your assets in a pension program earning nothing or maybe negative. You can't have a pension program. So these things are all going to get restructured. They can't stay in the same form. So the government, their ultimate goal is to create inflation. And, my view is, look, that's what they're trying to do. And I think gold and silver now, some of these early stages after coming back, is sensing the instability, the fact that the current situation is not stable. The governments are trying to create some inflation. But from my perch, even if the government doesn't create the inflation, if you will, which is, maybe possible, or you go into a deflationary situation, either way, you need to protect your money, because if you go with inflation, yes, gold is a wonderful, wonderful hedge and will work very well. If you go into a deflationary situation, which means they've really lost control, and I think negative interest rates are causing people to really step back and get more concerned and actually hoard cash. We've seen this behavior in Japan. We've actually seen, I think negative interest rates are actually slowing down economies. Certainly businesses aren't making the kind of capital investments in the future and doing more financial engineering. But if you go through a deflationary situation where asset prices were to come down, it would wipe out the banking system. So you still want to have precious metals, and I think you'd want to have that which is tangible, lasting, enduring, and will maintain purchasing power. So for my perch, it's hard, and I know what they're pushing towards. They want to inflate, I should say, and debase currency. Whether they'll be successful at that, I guess we'll have to wait and see. They're trying everything they can. One of the concerns that I have is that the current QE process really hasn't worked at all. It hasn't worked. The lowering of interest rates is not stimulating growth. And so what they're talking about now, and you're very much aware of this, is this sort of helicopter drop where you get governments just to go larger and larger in deficits, and then you just monetize the debt to the central banks. Now, if they do that, then I think that potentially it could create inflation, but they'll destroy the value of investors' money. They'll destroy capital value, and the only way you're going to protect that, again, is you've got to own what is essential, scarce, and will be repriced with some value in the future after going through a bit of a reset. And certainly one of the main components of that would be precious metals, no question.
All right, Jonathan, well, let's finish up with the question on the general equities. I'm talking about the U.S. stock market. The U.S. stock market's been a huge benefactor of the easy money that started in 2008. The beginning of this year started pretty ugly, but we've now seen essentially a full recovery in those losses. And that brings up the question, where's the stock market heading? It's overvalued by several metrics, but with easy money flying around, maybe it's a place for people to put some of their money. Where are you positioning people? Do you have them in any of the big name stocks? Do you see the Dow being able to make higher highs, or is this the top?
Well, we're bottoms up, largely bottoms up, sort of fundamental when it comes to the individual stocks. I mean, having said that, you have to contextualize, and that's why we've been talking about the macro. Anyone who says they're completely bottom up and doesn't contextualize all of their investments into the bigger picture, I think is a bit naive and probably doesn't really do that. But when it comes to the individual stocks, what we're trying to do within the context of what we've talked about, the debt problem, is okay, we want to find, if we're outside of the precious metal sector, where are there industries that we can find great businesses with big moats, not ridiculous leverage, good management, where there's hard assets around them, okay, so that there's tangibility. It's not a paper business that's been overly financialized and is vulnerable to the problems that can emerge, in the financial crisis. So we look at, say the water industry, for example. You look at that, and it's hard to get water reserves, but we'll try to find businesses that are in that sector, like an Xylem or an American Water Works that we've owned for some time, or an Eco Lab. So these are businesses that work in that industry. They help companies be more efficient, drive efficiency in the water industry. It's an essential industry. There's hard assets behind it. We'll look at different infrastructure companies that are well financed, because again, one of the things that we look for, we saw this in 2008, 2009, is that poorly structured companies with bad balance sheets will get cleaned out, but the companies with better balance sheets will be able to buy assets cheaply. So if you're in a company that's got a strong balance sheet and has access to capital, we saw this with some of the Brookfield businesses that we have some exposure to, then they can buy up great assets at cheap prices, because people have had, been very, very poor in structuring businesses. So we'll look at infrastructure businesses. Some of the technology companies, we have some positions in some of the tech companies, because again, we have to buy them where they're reasonable price, because technology is indispensable. It's a core part of our infrastructure, and agriculture also. So we look for good companies in those spaces. But the key there, or what's the link between, say, gold and silver and some of the businesses that we're looking at, virtually all the businesses we're looking at, is the businesses underneath them have solid, stable, tangible assets that, regardless of financial conditions over time, are needed. They're going to be around. Human beings need food, they need water, they need basic infrastructure, and so forth. So what we stay away from, and what we wouldn't get close to, would be highly levered, banks, life insurance companies, anything that's a long duration financial asset, because a long duration financial assets could get cleaned out, in a debt crisis. So there's certain areas that we won't go near, and then other areas we think in terms of great opportunities, but could be from volatility. But how do we get through the challenges? So look at those businesses. And so you get back to the U.S. market, I think overall it is expensive on any kind of reasonable valuation basis. So we dabble, we pick off stocks where we see opportunities, and then we keep a little powder dry. So we have optionality so that we can step in quickly. We loved it when the market came down earlier this year. It was great, but then it rebounded too quickly. So we took advantage in the number of portfolios, but we've backed off now. And so we're just watching. We'll hope for more volatility so that we can dollar cost average and pick away the companies that we really like, that we think are going to be around the long term and survive the debt, the derivatives, the crazy government promises, the negative interest rates, the money printing. This too shall pass, but we want to be in the companies that will take us through that without destroying value.
Okay, well, Jonathan, I really appreciate you coming on the show and taking half an hour out of your busy schedule to tell us about RockLinc. Just for our listeners, one more time, it's RockLinc, LINC.com, RockLinc.com. Jonathan, thank you so much for coming on the program with us.
Thank you very much, Colin. It was wonderful to talk with you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?